90% of traders have no idea how powerful these patterns are. But today, you'll learn how to predict the market like a pro. There are 3 simple candlestick patterns that, if you master them, will help you predict the market like a pro. In this video, I'll introduce you to 3 powerful reversal candlesticks that can provide ideal entry points. How do these candlesticks form? How should we trade them? How can we increase our win rate using them? So far, I've introduced you to several profitable trading setups that frequently appear in the market. If you've tried them and made profits, let me know in the comments. It really motivates me to keep going. In upcoming videos, I'll introduce even more setups, so make sure to subscribe so you don't miss out. See you after the disclaimer and intro. Welcome back, traders. So, let's get started. Most traders see these candlestick patterns but don't know how to trade them, missing out on golden opportunities. After this video, you won't be one of them. The candlesticks we're talking about are pin bars, long shadows, self-covering candles. We call these 3 types of candlesticks conditional pivots. Previously, in a video linked above, I explained pivots in more detail. However, mastering pivots requires more practice and study. Once you master them, you can generate significant profits with high win rates across all chart movements and time frames. In general, we can describe pivots as follows. To form a pivot, we first need a leg. As we've mentioned before, in our trading style, all chart components are tied to a time frame. Having a time frame results in an excellent risk-to-reward ratio. Therefore, each leg also belongs to a specific time frame. For a leg to belong to a particular time frame, its minimum length must be 240% of the ATR. Why do most traders miscalculate ATR and end up losing money? This is where professionals separate from amateurs. You can use the ATR with a period of 24. However, in our custom trading view indicator, these values are calculated and provided for you. First, measure the length of the leg. This leg can start from the end of the previous leg, after a pullback, or after a base. Once we've identified the leg, for a pivot to form, there must be a reversal from the end of the leg equal to 1 ATR of the same time frame. Additionally, the knot in the last 1/3 of the leg must be engulfed. When this knot is engulfed, it means there are no more orders in that knot, allowing the price to continue its new movement. After the 1/3 knot is engulfed, we can enter a trade when the price revisits the pivot tip at the knot FTC. The 1/3 knot and the FTC knot are bases or pullbacks visible in the trigger timeframe. The trigger timeframe is 2 timeframes lower than the current timeframe. So far, we've summarized the concept of pivots. Now let's get to the main topic: conditional pivots. Conditional pivots are unique because they have a specific shape. They don't require a reversal candlestick or the engulfing of the 1/3 knot. All we need is a leg followed by one of these 3 candlesticks. In this case, we expect the price to reverse from the FTC zone of this candlestick. If you master these 3 candlestick formations, you'll leave most beginner traders behind and boost your win rate dramatically. There are 3 types of conditional pivots. 1. Long shadows. 2. Self-covering candles. 3. Pin bars. Shapes of conditional pivots. Long shadows. Some traders panic when they see this candle and miss out on an easy trade. But after today, you'll know exactly what to do. Long shadows must only have a shadow size between 80% and 120% of the ATR for the time frame. All the candlesticks shown in the image below are long shadows. Self-covering candles. This candlestick provides one of the smartest signals in the market, but very few traders actually know how to use it, until now. There are 5 conditions for self-covering candles. 1. The candle must be standard, long, or a spike, meaning its length must be more than 80% of the ATR. 2. The candle body length must be at least 1/3 or 1/4 of the total candle length. 3. The body and shadow lengths should be approximately equal. 4. The body color of the candle must align with the direction of the new trend. 5. The shadow's direction must align with the new movement. Look at the image. Among the 5 examples, only number 2 is a self-covering candle. Pin bars. If you could only trade one candlestick pattern for the rest of your life, this would be it. Why? Because the market reacts to it almost every time. Pin bars have 4 conditions. 1. The pin bar length must be more than 120% of the ATR, meaning it must be a long or spike candle. 2. The candle body length must be 1/4 of the total candle length, and the candle must close within the last 1/4 of its range. 3. The candle must have a noise shadow, and the noise shadow length must be less than 10% of the total candle length. 4. The pin bar's color is not very important, but it's better if it aligns with the new trend direction. In the image below, all possible pin bar shapes are shown. Optimal trading zone for conditional pivots. 99% of traders get this part wrong. They think they should enter trades directly at support or resistance. But the real secret is this. In all 3 cases, there is one shared trading zone, which is the FTC zone, the 50% shadow zone. We locate the 50% shadow zone in the structure timeframe, then move to the trigger timeframe to identify a trading knot in that zone. When the price reaches this zone, we enter the trade. An important point about the FTC zone is that it is a one-time use zone. You should only trade in this zone once, because if the price returns to this zone again, the likelihood of it breaking through the knot increases significantly. For long shadows, this is the only trading zone available. However, for self-covering candles, there is an additional trading zone around the open of the candle. After identifying this zone, move to the trigger timeframe, locate the trading knot, and enter a trade on that knot. For pin bars, there are 2 important trading zones, and it is possible to create multiple successful setups when trading with pin bars. 1. The first zone is the 50% shadow zone of the pin bar. 2. The second zone forms if the candle immediately following the pin bar confirms it. For example, if the prior trend is bullish, the candle after the pin bar should close below it. If the trend before the pin bar is bearish, the next candle should close above it. When this condition is met, another trading zone forms for the pin bar, as shown in the image. In this case, move to the trigger timeframe, identify the knot, and trade in it as the second FTC. Conditions for high win rate trades. The location, timing, and structure of the conditional pivot formation have a significant impact on the success rate of trades. This is where the difference between an amateur and a pro trader becomes clear. Pros enter at these points, while amateurs only realize what happened after the move is already over. 1. Location of conditional pivot formation. To identify the optimal location for a conditional pivot, pay attention to the following 3 points. 1. Compressed or congested markets. When the market is in a compressed or congested state, and then breaks out of this zone with a long bar, conditional pivots often form after these long bars. Price easily passes through the hidden long shadow zones of these pivots. These pivots are essentially pullback pivots that form after levels are broken and are not suitable for trading. This congestion, as shown in the image, can appear as either a base or a CP. 2. Pivots aligned with the higher time frame trend. Pivots that are aligned with the movement of the higher time frame are more reliable. Pivots that oppose the market trend are not suitable for trading. For example, if the price is moving between 2 daily levels, forms a pivot near the lower level, and is moving upward, the pivot formed during the movement toward the next daily level is not suitable for trading if it is in location 1. These pivots form for liquidation purposes, and their FTC zones lack the strength to reverse the price. However, pivots formed at location 2 are suitable for trading because they reverse the price in alignment with the higher time frame trend. Note: we've previously explained how to determine the time frame of levels in a separate video. I highly recommend watching that video. 3. Pivots after level breakouts. Pivots that form after a level breakout are suitable for trading if they align with the movement after the breakout. For example, if the price breaks a weekly level and forms a pivot in the trigger time frame. A pivot in location 1 can be easily surpassed by the price, while a pivot in location 2 is suitable for trading. For pin bars, there are additional considerations. I recommend watching the video on pin bar candlesticks for more details. 2. Timing of conditional pivot formation. Your trade timing is just as important as your strategy. One small mistake here equals account blown. Conditional pivots formed during low-volume sessions are not reliable. Therefore, conditional pivots formed during the London and New York sessions are far more significant. 3. Structure of conditional pivot formation. After the formation of a conditional pivot candlestick, especially long shadows and pin bars, the shadow zone of the candlestick must be identified. Then, move to the trigger time frame and examine the structure of the shadow formation. Shadows are formed by price movements in the lower time frame, which can take one of the following 4 forms. 1. Both the movement to and from the shadow are sharp. A sharp movement means there is minimal or no noise during the price movement. In this case, the trade has a 90% success rate because the sharp return indicates the presence of orders, allowing you to trade in the 50% zone. 2. The movement to the shadow is sharp, but the return is congested. This type of pivot has a 50% success rate because the congested return suggests weaker momentum. 3. The movement to the shadow is congested, but the return is sharp. This setup has a 90% success rate because the sellers are significantly stronger than the buyers. 4. Neither the movement to nor the return from the shadow is sharp. This setup has a 0% success rate because both movements are congested, indicating that the pivot formed during a low-volume market period. Stop loss and target placement. You can place your stop loss above the shadow or the knot and set your targets at 1, 3, 5, and 7 times the risk. We will provide a detailed explanation of targets and stop loss placement in a future video. Key point about the 50% knot. The 50% knot doesn't have to be exactly at the midpoint of the shadow. This knot can be anywhere between 20% and 80% of the shadow. The 50% midpoint is an approximate reference. You need to locate the knot in the trigger time frame and optimize the targeted zone. All right, friends, that's the end of this tutorial. If you've tried this strategy and it worked for you, drop a comment below. I might review your trades in an upcoming video.